Imagine waking up one morning to discover that the dollars in your bank account, the ones you've worked your entire life to save, are suddenly worth less than the paper they're printed on. Prices for groceries, gas, and rent have skyrocketed overnight, and your retirement fund has evaporated into thin air.
This isn't some dystopian nightmare, it's a reality that has played out time and again throughout history. From ancient empires to modern nations, financial systems have crumbled under the weight of greed, mismanagement, and unforeseen shocks.
But amid the ruins, survivors emerge stronger, armed with timeless strategies to safeguard their wealth. In this video, we'll dive deep into some of history's most devastating collapses, uncovering the patterns that repeat and the lessons that can protect you today. Because in a world where trust in money is fragile, knowledge isn't just power,
it's your best defense.
Let's start with the Roman Empire, a superpower that dominated for centuries but ultimately succumbed to the slow poison of currency debasement. In the early days, the silver denarius was a symbol of stability, containing nearly pure silver and accepted across vast territories. But as emperors like Nero and later ones faced mounting wars, lavish spending, and economic pressures, they began reducing the silver content, replacing it with cheaper metals like copper. By the 3rd century, under emperors such as Gallienus, the denarius was little more than a bronze coin with a thin silver coating. Inflation soared as people realized the money was being diluted, leading to skyrocketing prices and eroded trust. Merchants refused the debased coins, demanding payment in kind or older, purer currency. The empire's economy fractured, contributing to its eventual fall in the West by 476 AD. What protected the wealthy during this era? Not hoarding the failing denarius, but shifting to tangible assets like land, gold, and commodities that governments couldn't manipulate. Roman elites who diversified into vineyards, farms, and precious metals reserved their fortunes while the masses suffered.
This ancient tale warns us, when leaders print or debase money to fund deficits, real value migrates to assets immune to inflation.
Fast forward to the 20th century, and we see a more explosive version in Weimar Germany, where hyperinflation turned millionaires into paupers in months. After World War I, Germany was saddled with massive reparations under the Treaty of Versailles, owing billions in gold marks to the Allies. To pay debts and fund reconstruction, the government cranked up the printing presses, flooding the economy with paper money. By 1923, inflation hit astronomical levels, prices doubled every few days. A loaf of bread that cost 160 marks in late 1922 soared to 200 billion marks by November 1923. People wheeled barrows of cash to buy essentials, and workers were paid twice daily to spend wages before they devalued further. Savings accounts were wiped out, pensions became worthless, and social unrest boiled over, paving the way for political extremism.
Yet, some thrived. Those who borrowed heavily in depreciating marks to buy real estate or stocks repaid loans with inflated currency, effectively getting assets for free. Farmers and industrialists with goods to barter avoided the worst. The lesson here is stark: hyperinflation punishes savers who cling to cash but rewards those who convert to hard assets early. If this chilling account of money's fragility has you rethinking your portfolio, hit that like button and subscribe to Real Financial Truth. Comment below. What's one asset you'd stockpile if inflation spiked tomorrow? Shifting to the United States, the Great Depression of the 1930s stands as a homegrown cautionary tale of how market euphoria can lead to widespread ruin. Triggered by the 1929 stock market crash, where overleveraged speculation burst the bubble, the crisis even due to bank runs, protectionist tariffs like Smoot-Hawley that strangled trade, and a contracting money supply as the Federal Reserve failed to act. Unemployment hit 25%, factories shuttered, and Dust Bowl famines compounded the misery. Millions lost homes in foreclosures, and soup lines became a symbol of despair. President Hoover's initial hands-off approach gave way to FDR's New Deal, which introduced reforms like FDIC insurance and Social Security. But for individuals, survival hinged on liquidity and diversification. Those with cash reserves snapped up undervalued stocks and properties during the downturn. Think of how Joseph Kennedy amassed a fortune by buying when others sold in panic. Gold hoarders benefited when FDR devalued the dollar against gold in 1934, boosting its value. The Depression taught that over-reliance on credit and stocks without buffers is deadly. Instead, maintain emergency funds, avoid debt traps, and invest in skills that provide income even in hard times, like farming or trades. Across the globe in Zimbabwe, a more recent hyperinflation saga illustrates the perils of political mismanagement and land seizures. In the early 2000s, under President Robert Mugabe, the government seized white-owned farms to redistribute to loyalists, devastating agricultural output and exports. To fund deficits and military adventures, the Reserve Bank printed Zimbabwean dollars relentlessly. Inflation peaked at an estimated 89.7 sextillion% in November 2008, rendering the currency useless. People used it as wallpaper or toilet paper. A $100 trillion note couldn't buy a bus ticket. The economy shrank by half, unemployment soared to 80%, and barter systems emerged. Salvation came for those who ditched the local currency early, holding US dollars, gold, or foreign assets. Entrepreneurs who traded in goods like fuel or food maintained wealth, while savers and banks lost everything. Zimbabwe's collapse, which ended with dollarization in 2009, underscores that when governments destroy productive capacity, no amount of printed money saves the day. Protect yourself by internationalizing assets and building self-sufficiency. Venezuela's ongoing crisis echoes this, showing how oil dependency and socialist policies can trigger a downward spiral. Once Latin America's richest nation, Venezuela under Hugo Chavez and Nicolas Maduro nationalized industries and funded social programs with oil revenues. But when oil prices crashed in 2014, combined with corruption and price controls, the bolivar plunged. Hyperinflation hit 1.7 million% in 2018,
with the government printing money to cover deficits while imposing currency controls that fueled black markets.
Millions fled as shortages of food and medicine led to malnutrition and protests.
The bolivar was devalued multiple times, and new currencies like the sovereign bolivar failed to stabilize things.
Survivors?
Those who converted savings to cryptocurrencies, US dollars, or gold before restrictions tightened. Expatriates sending remittances helped families, and skilled professionals emigrated for better opportunities.
Venezuela reminds us.
Avoid economies tied to single commodities, steer clear of heavy debt in volatile currencies, and cultivate portable skills for global mobility. Even in the modern US, echoes of these collapses persist, as seen in the 2008 Great Recession and the 2023 Silicon Valley Bank failure. The 2008 crisis stemmed from subprime mortgage lending, where banks bundled risky loans into securities, leading to a housing bubble burst.
Lehman Brothers collapse triggered global panic, with stock markets plunging 50% and unemployment doubling to 10%. Bailouts saved big banks, but homeowners faced foreclosures.
Those who protected wealth had diversified portfolios, low debt, and cash to buy distressed assets. Warren Buffett famously invested billions during the dip.
Fast forward to 2023.
SVB collapsed due to unrealized losses on bonds amid rising interest rates, sparking a bank run as uninsured tech depositors withdrew $40 billion in a day. It highlighted risks in concentrated sectors and poor risk management.
Lessons?
Spread deposits across banks, understand FDIC limits, and monitor interest rate exposure. These events prove too big to fail is a myth. Always have backups like credit unions or treasuries.
Pulling these threads together, history's collapses reveal universal truths for wealth protection.
First, diversify beyond fiat currency. Gold, silver, real estate, and productive land have endured when money fails. Second, maintain liquidity, cash or equivalents, to capitalize on fire sales during crises. Third, minimize debt, especially in foreign or volatile currencies, as devaluation can amplify burdens. Fourth, build skills and networks. In Weimar or Zimbabwe, producers and traders thrived while passive savers perished. Finally, stay informed and act. Early doubters who spot cracks survive, while optimists get crushed. In today's world of mounting debts, geopolitical tensions, and potential shocks, these strategies aren't optional, they're essential. If these insights have equipped you to face uncertainty, smash that subscribe button on Real Financial Truth, like this video, and comment your top protection tip.
We'll discuss in the next one.
Remember, financial systems aren't eternal. They're built on trust that can shatter. But by learning from Rome's debasement, Germany's frenzy, Depression-era hardships, and modern meltdowns, you position yourself not just to survive, but to thrive when others falter. History doesn't just repeat, it rhymes, and those who listen build unbreakable resilience. Thanks for watching. Stay prepared, stay wealthy.